U.S. natural gas futures slipped nearly 1% to a one-week low on Friday, pressured by a modest rise in production and persistently high storage levels. Front-month gas futures for November delivery on the New York Mercantile Exchange fell to $3.30 per million British thermal units, putting the contract on track for its lowest close since October 17. Meanwhile, the U.S. National Hurricane Center projected Tropical Storm Melissa would strengthen into a hurricane on Saturday as it slowly heads north and then west across the Caribbean Sea near Jamaica before continuing north toward Cuba by the middle of next week. The system is not currently expected to reach the U.S. mainland during that time. Even though storms can boost U.S. gas prices by cutting output along the U.S. Gulf Coast, they are more likely to reduce prices by shutting LNG export plants and knocking out power to homes and businesses. About 40% of the power generated in the U.S. comes from gas-fired plants. Average gas output in the United States has fallen to 106.7 billion cubic feet per day so far in October, down from 107.4 in September. Record output earlier this year allowed energy companies to inject more gas into storage than usual. There is currently about 5% more gas in storage than normal for this time of year. Meteorologists forecast temperatures across the country will remain mostly near normal through November 8. With the weather turning seasonally colder, analysts projected average gas demand in the lower 48 states, including exports, would rise from 101.7 billion cubic feet per day this week to 107.8 next week and 108.5 in 2 weeks. The average amount of gas flowing to the 8 big U.S. LNG export plants has risen to 16.5 billion cubic feet per day so far in October, up from 15.7 in September. On a daily basis, LNG export feed gas hit an all-time high of 17.29 billion cubic feet per day on Thursday, topping the prior record of 17.28 on April 9, with flows to Venture Global LNG's 3.2 billion cubic feet per day Plaquemines plant in Louisiana at a record 3.7 billion cubic feet per day. LNG plants can pull in more gas than they can turn into LNG because they use some of the fuel to power equipment. Natural gas futures closed the week around $3.30, retreating from recent highs as bearish fundamentals, elevated storage and steady production continue to weigh on sentiment. From a technical standpoint, the market is entering a critical short-term zone. The 50-day moving average near $3.07 serves as strong support. A decisive break below the $3.20 level could trigger further liquidation toward $3.10 zone, where stronger buying interest is likely to re-emerge. Conversely, if prices manage to hold above $3.30 and rebound, resistance is seen around $3.50, a region that capped gains earlier this month. Momentum indicators are neutral to slightly bearish, suggesting the market may consolidate before its next major move. However, traders should watch for potential volatility from early season cold fronts. Any shift toward colder than expected forecasts could spark short covering and push prices back above $3.50. Overall, mildly bearish bias persists, though a rebound remains possible if colder weather emerges or LNG exports continue to hold near record levels. Don't forget to comment, share this video to support the channel, and show some love. See you next time.